Mm.
It's not
Yo,
letting you.
everybody.
What's up, Stoney? It's not letting you join. That's interesting. J-Pone. But yeah, that studio is insane. I'll share my screen. It's a 360-degree video studio for 250 euros an hour. You can change the background to whatever you want. Like I think he's gonna be doing a whiteboard master class or presentation in it. Amenities. It doesn't have a sink though. It just says amenities here. Chairs, Wi-Fi, no sink, lighting, and no lighting and equipment. What's up, Bexa? Yeah, I posted in VP Plus for people if they want to join. For everybody that's from VP Plus and you have no idea what you're getting into, we're going to be talking about asset rotation theory today, which is basically the three major asset classes of the world and how do you design investment strategies that rotate between those asset classes depending on what happens or occurs in the world. Yes, stonks. We're talking stonks. Ah, fuck. I just okay. I didn't get anywhere. Yeah, I can show you a super simple strategy that is probably the Nasdaq 99 strategy. That's really good. That a little bit better than the S&P 500. Um, but okay, looks like we're getting everybody that we're gonna get in here. So, what's up, Aaron? Haven't seen you in a minute. Seen you talking a lot. If I remember right, you work in oil and gas. Is that correct? I can't remember. Vox. How's oil and gas going? Okay, let's. Yeah, I actually haven't even looked at oil. Let's check out oil. $80. I mean, looking at USO. What's the actual oil price per barrel ticker? $90. That's CFDs. What is the ticker for oil? That's what USO is. That's it's roughly the same. Recommending into investing into Tesla or Apple. It's interesting. I don't give recommendations. I don't really study Tesla enough to give you a educated guess on that or educated advice on that. But I did literally just build a Tesla strategy this morning. I was just kind of screwing around with it. Okay, let's hop into it. Let's get into the education. So today, there's a few more people that just joined. We are talking about asset rotation theory, which is the idea of the three major asset classes of the world and money flow. So I'm a firm believer in the law of thermodynamics and that money cannot be created or destroyed. It can only be rotated unless you're the Federal Reserve. Which quotations in here. Unless you're the Federal Reserve. For the rest of us, we are not. I guess you can light money on fire if you want, but you probably don't have enough money to light on fire to influence the world. So yeah. So there's three major asset classes in the world. There is equities, which are stocks, companies. These are basically entities that produce goods or services for the economy and other people. That's the technical definition of equities and stocks. Then there are commodities, which are raw resources and materials. These are like oil, gas, natural gas, technically not energy, but like sugar cane, wheat, pretty much anything that is a physical good or material, fish, whatever, doesn't matter. Those are commodities. Yeah. Then there is the last major asset class of the world is bonds or government debt. Essentially, these are IOUs. The way that a bond actually works is I basically negotiate a contract with you, and I say you give me money, and then in X amount of years, I will give you back X dollars with a certain percent return. Basically, a guaranteed debt. It's just kind of like a mortgage. There's different versions of bonds and IOUs actually, and then there's also derivatives, but we're not going to make it complex. For this call, we're basically going to look at equities, commodities, and bonds or debt. Now, there are factors that influence these asset classes, and that is the Federal Reserve and the Fed's increasing interest rates and increasing inflation. So, as some of you have been paying attention to the stock market over the past couple of years, when inflation goes up, commodities go up as well as equities. And then bonds usually go down. And then as interest rates rise, bonds get hammered, and equities can, over a longer time frame, get hammered down because it's harder to grow a company when you have high interest rates, and it's harder to get cash flow and investments. So that is the three major asset classes. So let's talk about sector rotation theory and how it can be applied to investing and algorithmic design. First, we're going to take a look at the S&P 500. This is the S&P 500 over the past 150 years, back to 1886. And you'll notice that there are periods here in the S&P 500 where we go sideways for a little bit. But there are also these massive bull runs that occur for 10 to 20 years. Now, the sideways markets occur. So you've probably heard the saying that if you invest in the S&P 500, you'll roughly get like an 8% return year over year over a 30 to 50 year period. And that is true when you incorporate the sideways markets. However, if you remove these sideways markets from the equation, this is actually what you get. So here's the 1950s bull run. This is a 677% increase in value over uh, roughly 242 bars. 242 divided by 12 months is 20 years. So we're going to take 671 um, divided by, what was that, 22? Yeah, 20. Roughly a 33% increase in value over the 1950s to 70s through that bull run. Then we're going to go to the 1980s, where we have a 1,500% value increase over roughly 20 years. We'll do 270 bars divided by 12, 22 years. 1595 divided by 22 years is a 72% increase in value over those 20-year periods. So that is an annualized return of 72%. A lot higher than the average 8% a year that everybody talks about. So, current bull market, 330, actually, okay, what is it? So, inflation, so technically, no. On a technical perspective, no. Inflation occurs from printing money. The leading indicator of inflation would be the Fed balance sheet. So, if you want the most accurate uh, projection of inflation, it would be this chart, which is where's it at? Fed asset sheet. I'll post this in here. You guys can save this, use it, do whatever you want with it. But this is essentially a measurement of the Fed's printing money. This is housing market crash when they printed money through the 2000s up into 2020. Then this is the huge COVID spike, and then this big run up here, and this is where we're currently at. So this is probably the most accurate or most up to date chart on this. Now, and I've never actually tried this, but let's take a look at let's compare PPI ACO to, I'm kind of tangenting right now, but does anybody know the ticker for the Fed balance sheet? M2 money supply, correct me if, refresh me on M2. I'm familiar with it, but I can't remember the definition. That could be another metric. Let's take a look at both of them. So this is the Fed balance sheet. It looks like inflation. So commodities is lagging to the PPIACO, or sorry, commodities is lagging to the Fed balance sheet. Let's do M2 money supply. Mm, I think they're in conjunction. So commodities. So we had this big spike here. Commodities lagged. M2 money supply. Interesting. So PPIACO is the blue one. Let's just make it super thick so everybody knows. Um, yeah, so the gold one is commodities. So this is commodities. This is M2 money supply. So this is money in circulation. That's current. So they're all kind of in conjunction. Um, yeah, yeah. Y- Yeah, is the technical definition of M2 in circulation? Retirement accounts, retirement accounts balances and time deposits above $100,000 are omitted from the M2. I'll have to look into this. That's a good good question. We might be another thing to discuss on another call, or we can come back to this after this call. Let me get through the presentation, and then we'll jump back into that. So this is the current bull market, 313% a year, which is roughly 10 years, or a 31% annualized return year over year through this one. So, long story short, if you figure out how to remove the sideways chop of the markets, or you find a way to invest your money into something that is growing during these sideways chops, you can basically beat the S&P 500 on its 8% a year returns. Now the question is, how do you do that? Well, I already kind of, foreshadowing. There's other asset classes, and money cannot be created or destroyed. It can only rotate. So the question is, how do we find these rotations, and how do we capture the rotations? So this gets us to PPI ACO. So PPI ACO is the chart we were literally just looking at. Let me turn off the M2 money supply, and I'm going to add SPX onto here. This is the S&P 500. Uh, and let me get rid of all these other charts. So now we have the SPX. So PPI ACO is here, SPX is over here on the second bar. And get rid of my drawings. Now we have we're looking at the World War II, or sorry, World War One, 1916 to 1920. Now during this period, War breaks out. Commodities run 143% in a matter of 4 years, which is roughly a 30 to 37% annualized increase. And you can see that equities, it's kind of hard to see, but there's little dashes here that are the US stock market, go sideways through the war. Now, the reason that commodities rise during war is shipping lanes get attacked, railroads get bombed, ships have to sail farther, they have to go around the Cape of Africa or the Cape of South America. So the expenses of commodities increase as well as the demand for commodities increase because you have to fund the war, you have to have materials to make weapons and ammunition and supply your soldiers and machinery and all that stuff. Now, a secondary downline effect is there's also an increase in production. So more wells and oil rigs are built, more mines are being created, and more infrastructure to produce commodities is built during wartime typically. So once the war ends, you see a massive collapse, and the price of commodities actually go from $28 to a matter or to $16 in less than a year. Now, if you're a company, if you're in the equities sector of the market, and all of a sudden you wake up and your cost of goods sold or your cost of doing production is reduced by 50%, well, guess what? You're going to have a massive bull run on your stock market or your equities. So you have all of the production of commodities during the wartime now gets converted into civilian equities, and we have a huge bull run through equities. Then you have the Great Depression. So there's a lot of reasons you can say as to what happened in the Great Depression and why it occurred. My personal opinion is it's just a natural mean reversion from commodities. So if you draw a trend line here, it's kind of hard to see, but there are dashes here. But if I can I turn off my charts for Bruce's price index? Let's just do it there. But yeah, you can see that it's basically just a trend line from the PPI ACO. Let me see if I can turn this off real quick. There we go. So yeah, equities, it's basically just a mean reversion back to the mean. Then we have World War II. So let's check out World War II real quick. And I lost my chart. So we get into the Great Depression. Commodities hit a low of $10 and then they spike up to around $12 through the right before the war. Then war breaks out. Equities kind of have a bull run, and commodities end up climbing from $13 to 26, $28, $30 by the end of 1950. Now, if we go back to this, that is a 12 to 15% increase over a 10-year period through the war while equities go sideways and do nothing. Then we hit the 1950s, commodities basically flatline at $30 for the next 20 years, and we have a huge bull run in equities, which I already showed you. Like I think it was like a 30 or 40% annualized return, year-over-year return. Then we have the gold standard and Nixon axing the gold standard, the Bretton Woods Agreement, and the uh, oil crisis of 1990s and the petrodollar being emerged. Then we have a rise in commodities while equities go sideways for the 1970s. Commodities run to $100 before the end of the next bull run. And this is where I'm going to throw the gold chart on. So I'm going to throw gold on, and this is gold over this period. And you can see that gold started at $30 per troy ounce and immediately skyrocketed to 50 or $140. So the gold price is over here, by the way, this side of the chart. $100, $800, and at its peak, it hit roughly $890 within a 10-year period. So real quick, $890 minus 35, 850 divided by 35. 246% increase in value times 100. That's a 24,000% increase in value over 10 years divided by 10 years. 244% annualized increase, 240% return year over year through the 1970s for gold. Now, this will never happen again, probably, because the reason it happened is because it was unleashing an inflation spiral of the past 20 years where the Federal Reserve continued to print money. I don't have time to get into the Bretton Woods Agreement, but we can come back to this and talk about why this occurred if somebody wants to know more. Let me just get through the presentation. So we have the breakout of the 1980s, and the next chart I want to throw on here real quick is Fed fund rate. So this is Federal Reserve interest rates. And you can see that interest rates rise up into the 1960s. They have a huge spike. So they actually spike up really hard as the Bretton Woods or the gold standard gets cut and we switch to the petrodollar, trying to fight inflation. Gold has a massive spike. And you can see that the interest rates kind of follow the spike of gold to kind of combat the inflationary spiral and the inflationary effect of what's happening. And then it starts to drop as well as gold starts to drop through the 1980s and 90s while equities have a huge bull run doing their 60 70% a year return year over year. Interest rates hit zero, we get into 9/11 and the Afghanistan war. Commodities and equities have a temporary dip. Gold, which is right here, is actually breaking out. It's broke its downtrend on a technical pattern, and gold goes from gold starts at $270 through 2003, and by the top right before the housing market crash, gold hits a high of $900 again, basically back up to its top. And if we turn off all of the other indicators real quick, you can see that gold has broken its previous high. So now we're in a breakout pattern on technical analysis. Turn back on the S&P 500, we have the housing market crash, we have interest rates to zero, commodities and gold spike down. But through the housing market crash, gold actually rises another 100% back up to about $1,800, $1,900. And interest rates at zero, the economy stabilizes, commodities flatline, and then we have the bull run of the past 10 years where commodities and gold basically go sideways. We have a small increase in interest rates through this period where the stock market kind of hiccups, but then we drop interest rates through COVID. We print a ton of money and have a huge inflationary leg on commodities, and interest rates are now trying to combat that. So that is 100 years of macroeconomics, and I think maybe hopefully 10 minutes. Um, and that is kind of an example or showing you visually how money flows in and out of different assets depending on what's occurring in the economy. Now, the common factors here are usually war. That's a big one. So, anytime world tensions increase, supply lines get constricted, the cost of goods increase, or the production of commodities increase, you typically have these effects, and they all kind of occur in the same ratio. Um, this is another really good chart to check out. It's actually a ratio chart of the S&P 500 and commodities. It basically shows you when it's a good time to buy the S&P 500 versus commodities. Surprise, it's usually during war periods. So this is World War One. This is the Roaring Twenties. This is World War Two and the Great Depression. This is the 1950s, 1970s, 1980s, and 90s, 2000 to 2001, and then the past 10 years. So, any questions on any of that? So Dogen M2 oversupply and shrinkage alone does not affect inflation. You have to take into account the monetary velocity, which measures how often the money supply circulates through the economy. Yes, that's what I was thinking. Is there's definitely a correlation to the circulation of money versus the total money because there's a lot of money just sitting doing nothing. In fact, I think over 50% of the stock market is actually locked into accounts that don't trade. Only 50% of the overall stock market, basically wealth, is actually actively traded through a year. I need to learn more about the velocity of money too. That's a very important one. I think I watched this podcast. Yeah, yeah, I did watch that podcast. That was a good one. So, what do you recommend to read to go deeper into this lesson? Ray Dalio. Most things from Ray Dalio, especially Big Debt Crisis. This is this is actually an economic. It's actually a three-part book. It's three books in one, and this was essentially a. This is kind of like an in the weeds, very technical read. You might want to have a bit of a background in like macroeconomics to read this, but it goes into. He essentially wrote these three books to give to world leaders to educate them on monetary policy. So, like, if you're a senator, if you're a congressman, if you're in parliament or a prime minister or a president, this is the book that you read to understand macroeconomics and help be more informed with policy regulation. So that's why that book was made. There's another really great book called The Changing World Order, which is more of a historical book that goes back to, I think, the Chinese Empire, the Ming Dynasty. And it basically shows the 250-year cycle of countries and world changing order. That's why it's called World Changing Order. But these two books alone are phenomenal reads when it comes to this stuff. Um, yeah, Principles is a really good book too. It's more on like building a business and bettering yourself. Lynn Johnson, Amazon Broken Money. I'll definitely check out this one. I haven't read this one. Um, those are the two books that come to my mind when it comes to this stuff. And then lastly, honestly, just reading charts, learning technical analysis and learning how to read charts and the algorithmic design can be a very useful thing. So let's yes, literally just looking at charts all day, every day can help out a lot on learning that because that's actual practical experience. You can read as many books as you want, but actually looking at the charts and messing with the charts is the best way to do it. And for those that might not know, the way that you add extra charts is just hitting this plus button up here. Always make sure that when you add a chart, you do new price scale because that allows you to do logarithmic versus uh, exponential charts. As you can see, um, these this is the exponential chart, and it's really hard to see long-term trends. Like you can't go back to the 1900s, but if I turn on logarithmic, now you can see the trend over a long period of time. All right, so let's hop into Composer, and I'll show you some strategies that I've built to do this. Actually, let's talk about sector rotation theory real quick because that's another very important one. Um, yeah, yeah. Anybody that has questions, feel free to ask them. You have any good educational videos, Doji, on velocity and specifically money supply? That'd be really useful. Um, okay, I'm gonna go through sector rotation theory real quick. All right. So there's also when it comes to the three major asset classes of the world, being equities, bonds, and commodities. Let me. Oh yeah, I forgot I have these charts here. Yeah, let me. I'll just use this as a presentation. I forgot I did all this. So I like this. There's a few different charts for this. If you search sector and economic cycles, there's a few different ones. Depends on which one you read. But long story short, there's also a rotationary theory on sectors. So if you're not familiar um, with the three major asset classes of the world, specifically equities, equities can be broken up into 11 sectors. So there's 11 sectors in the U.S. stock market. You can see it over here in my ticker chart. This is where's it at? Here's all the 11 sectors of the U.S. stock market. We have consumer discretionary, healthcare, utilities, real estate, consumer staples, technology, industrials, and financials, energy, as well as materials. And I'll share this. You guys can have my ticker chart. This is all of my tickers um, that I use in TradingView. It's got Bitcoin, it's Fed asset balance sheets, and all kinds of different metrics. Go through and try to learn about them. One of the best ways to learn if you want to learn about this stuff is literally It might take you a day, but literally go through every single ticker and just Google what the ticker is and what it does and why it's on here. There's a reason that I track every single one of these. Um, but yeah, that's a good way to learn technical analysis. So let's go to sector rotation theory. First, you're familiar that we have bull markets and bear markets. Well, there is a psychological effect that occurs with bull markets. Anybody that's traded or invested in cryptocurrency, you have probably experienced this. So we have the disbelief phase, the hope phase, the optimism, belief, thrill, euphoria, complacency, anxiety, denial, panic, capitulation, anger, and depression. And for those of you who are old enough to remember the housing market crash and the Occupy Wall Street events of the 2011, where they were occupying Wall Street. That was when we were in depression. And then you finally break out into the next wave and you have the next cycle. This is a psychological effect that has occurred for hundreds of thousands of years, or well, I guess tens of thousands of years, because ultimately the stock market moves because of people, and people are emotional, and the stock market has a collective emotion to it. So, is there anything I need to cover on this too? Um, I guess the last thing I would say on this is when it comes to the psychological movements of the market, it's better to pay attention to mass media and what mass media is saying. Don't pay attention to individual people, but like, I'll give you an example. There was a joke in the 1930s during the right before the Great Depression, where a Wall Street investor was getting his shoes shined on the street, and the shoe shiner was talking about buying stocks to him. And there's a joke that when the shoe shiner starts to talk about stocks, it's time to sell all your stocks because you're in the euphoria phase of a market move. And that actually occurred to me personally in the Bitcoin bull run. I was at my hometown at a bar, local dive bar, and a guy who does like construction or something came up to me and started asking me about Bitcoin and cryptocurrency and all these shit coins that he was putting money into. And I was like, the shoe shiner story came to my mind. But even I got caught up into the euphoria phase of Bitcoin. I was anticipating it running into $100,000, which just shows that we are all humans, and it doesn't matter what your experience level is, you are still susceptible to this stuff. So now let's get into more long-term economic movements. So when it comes to the 11 sectors of the market, there are bull runs and bear markets, and there are different sectors that will perform better during those cycles. For example, transportation and financials. Now, if you think back to World War One, um, and the PPIACO chart, this one right here, you have this huge production of resources being built through the war, and then it dumps all these resources into the markets for the free market and equities, and then we have a huge bull run in equities. Well, if you go back to transportation and financials, transportation is kind of the infrastructure of the world and what moves these resources around. So you'll have a bull run in transportation. And I guess in the digital age, you would also have a bull run in the digital infrastructure. So this all of this information is also built from like old economic theory. As we move into a more digital age, you'll see the same things occur. Like Starlink, for example, Starlink is increasing the world's internet speed, so you'll see probably a boom in digital transportation rather than physical transportation. But you'll still see both. Um, and then you have financial. So financial is investing in prototypes. They're investing in startups. They're investing in speculative investments that are going to revolutionize the next wave of technology. You usually finance is the first industry to basically finance that stuff. So then you get technology, the companies that are innovating and building new technologies and patenting and creating new stuff to put into the market. Then you have capital goods. This is because you have basic capital goods and basic industry. These are the kind of the midline section of production that are producing and distributing these services and products. Again, as we move into a more digital age, this will probably be more on the digital side of things. And then you have precious metals and energy at the top of the stuff. The reason that this occurs is because good investors usually invest their money down at the bottom of the bull market. So if we look at the S&P 500, um, and let's do candlesticks, and let's turn on PPI ACO. Uh, Actually, no. Let's just do gold. So let's say you're a billionaire. This is a good way to look at the market. You're a billionaire, and you have a pretty good understanding of all this stuff, and you have $1 billion to put somewhere. Well, let's say you just made. Actually, let's go to the SPX. Let's say that you just made a ton of money through the 1980s bull run, and then 9/11 occurs, and then war breaks out. Well, and then you also see gold has been flat for a while, and you understand commodity rotation theory. Are you going to speculatively invest in technology companies that are historically hammered during war times, or are you going to invest in infrastructure and wartime in commodities and wartime resources and make your money there? So you're going to rotate your money there and then moving up. So when it comes to asset rotation theory, energy and precious metals are usually a psychological defensive move of big money. So big money is taking their profits out of their bull run. If you had $1 billion invested in the 1980s, you're probably going to be scaling out of your investments here and looking for the next investment. And this is like the investment cycle theory. So energy and precious metals at the top, which is usually a defensive move on the psychological patterns. And then you have healthcare, consumers, and non cyclicals. These are consumer staples and essentially companies that are required to exist no matter what happens in the market. And then lastly, you have utilities and financials and consumer non durables at the bottom of the late cycle. And then the cycle repeats. So let's take a look at a chart or a strategy that actually does this. The .com 1999 bubble. Actually, what is the dynamic mod? No, that's not the one I want. Let's go to this one. Hello World. So we have the S&P 500 200-day moving average, and then we have QQQ, XLP, and XLK. So let's take a look at this strategy. Ran back to 2000 or 1999, comparing it to the S&P 500. Uh, you can see that S&P 500 this drastically outperforms it. For whoever said earlier that they invest in just the S&P 500, this is a phenomenal, simple strategy that you could take a look at to do a little bit better. So let's scroll back to the .com bubble, and you can see that the yellow line here is consumer staples. Consumer staples is companies like CVS, Walgreens, Coca-Cola, McDonald's, any company that's super old. It's going to be around. It's going to go through the recession. You can consider that consumer staples. Consumer staples usually does better than the overall stock market. So this strategy, if we just look at this part, rotates from the S&P 500 to consumer staples when the 200-day moving average is checked. So for those that don't know, let me turn off this, and I'm going to turn on my 200-day moving average. We're going to go to the daily chart. Let's scroll back. You can see the background that's green is when we're above the 200-day, and the background that is red is when we are below the 200-day. This is the 2001 .com bubble where we are below the 200-day moving average, which is the yellow line. So when we're red, we are going into XLP. When we are green, we're going to the SPY, and you can see that here. And you can see where it switches, and we capture the SPY right here. Now, this big run up right here, this profit moving, that's actually a mean reversion of the QQQ. So let's talk about mean reversion real quick. This is the 10-day RSI of QQQ. If you don't know what RSI is, I'll show you. This is the QQQ. We're going to run back to the .com bubble, and I'm going to turn on my RSI background. Actually, that's too noisy, and I need to fix that. I'll just turn on the RSI here. Switch this to the 10-day RSI. RSI is relative strength index. It is a measurement of X number of days, profits and losses averaged to 100. So you can see that it goes from 0 to 100. 30 is the bottom line, and 80 is the top line. Essentially, what we're measuring is the market being extremely oversold. So you can see uh, all of these points right here where we are hitting the below the 30. And what this strategy does is it takes a short term long position to capture profit on the upside. So this little move right here, we're essentially capturing a tiny bit of profit by buying XLK here and then selling it up here when it gets into its mean reversion. Now, this is how it profits here, but I can actually scrub this over and remove the mean reversion, and you can see that this strategy still performs better than the S&P 500 even without the mean reversions. So then we scroll over and we get into the housing market crash. The same thing occurs. Let me scroll in a little bit. We have XLP in yellow, and then we have our strategy that rotates into XLP when the market goes down, protecting our investments and averaging a better performance. And again, this is where I want to show you don't have to profit during a bear market, although that is nice, and there are ways to design strategies that do that. You just have to basically hedge your protection or hedge your investments. If you can just break even through the bear market over the next 10 years, that will give you a substantial improvement on your performance over the long run. So that's sector rotation theory, and this is a strategy that does that. Let's hop over to asset rotation theory. Actually, we can probably modify just this one. I'll just build a strategy and experiment, make a copy. Now, this is hindsight biased, but I'm going to mess with gold because I know gold performed well during the housing market crash, and I want to see if I can create something that captures the movements of gold. I was under the impression that RSI and oscillator indicator was guru wushu woo. Depends on who's using it. I mean, it's all technically all of this is financial horoscopes, I guess, or what's financial. There's also the opposite theory that, well, if you get into Munahisa Hama and so this, in my opinion, looking at the stock charts is just a visual representation of mass psychology because all of these assets, whether like the first assets to be bought and sold were chickens and cows and gold and silver and commodities. It was all commodity based trading through basically um, 10,000 BC up into the birth of Christ, and even up into the 1700s is when like modern stock markets started to emerge. But long story short, we have always, as a species, been buying and selling and trading stuff. You could go back to the 1500s or the Roman Empire, and if you tracked and drew out the daily prices of commodities, you would still see the same patterns being emerged. So is it horoscopes? Yes, I guess, and it's also it's trying to analyze and understand the psychological movements of value of I don't know. It's hard to fucking define what it is exactly. But technically, it could all be seen as horoscopes. Okay, 2007, September, and this is the current strategy. Now, I know that gold did really well during this period. So I want to build something that improves upon the hedge rotation. So we're going to delete this, and I'm going to do a rotation, and we're just going to try to capture the movement of gold. Um, let's do standard deviation of returns. Let's capture 35 days, and let's just see what happens. Uh, XLP and GLD. And we're going to add the original Hello World. So yeah, it does improve upon the gold. So what's happening here? Let me explain to you. 35-day standard deviation. Standard deviation can simply be seen as a throttle. So high standard deviation means you're selecting the highest throttled asset over an X amount of period. Low standard deviation is going to buy the least volatile, the most defensive asset in the basket that you're sorting. To visualize this, I will just throw on standard deviation, and you can see that standard deviation. Uh, there is one risk of standard deviation, and this is something you need to be aware of. Standard deviation will increase regardless if you're in a bullish movement or a bearish movement. So here you can see standard deviation is increasing, but we're in a bear market. And then let's go to a bull market. Actually, let's go to gold and I'll show you what this is doing. And we'll go back to 2000. Actually, let me switch this to a 35-day look back. Essentially, we're capturing the highest throttled uh, asset during a movement. So we have a collapse here, standard deviation increases, but standard deviation is still really high through this period versus XLP. So long story short, standard deviation is essentially selecting the most volatile asset. Now, I can actually switch this to bottom, and this might actually underperform. Um, no, actually, it still overperforms because we're selecting the least volatile asset. It doesn't do much different during housing market crash, but it does perform better through that period. 25-day standard drawdown. Let's go back. High standard deviation. 29%, 114,000. Okay. Curious if there's any way to input subsector industry groups into Composer if we want to add another layer of selection. Yes, there is Doji. You basically just need to find the ETFs that track those individual industries. So that's kind of learning the different tickers. And I actually, this is one of the most common requests out of all of the one-on-one calls that I've done. People want people want a visualization of like the breakdown of the sectors. So I think I'm going to build. I will probably just build a Miro sheet, like a Miro board that's S&P 500 broken into the 11 sectors, all of the ETFs that are attached to the S&P 500, all of the sector ETFs, and then all of the industry ETFs, and then I'll do commodities and I'll also do bonds as well, and that'll be like a reference sheet for anybody to use. Um, What other major global events besides wars, pandemics, and recessions to present divide the value of equities, commodities, and values? Um, I mean, that's embargoes. Yeah. What's this? Uh, Is this leading industries? That's interesting. That's really cool. Did you make this, Hassan? Where'd you find this? That's super interesting. I like that. What is it? Real estate's taking a hit. That's interesting that industrials is going down. My dad has had a crazy boom. Okay, so wait a second. This is oh, this is only the past few months. This- Okay. I wonder if we could get a chart of the why didn't utilities had a huge spike? It'd be nice to get like a 3-year chart on that. I'm gonna copy this though and save it. Just I'll organize it somewhere later. Um, okay, so I will not organize it later. I know I won't. I'll do I'll do the next presentation and I'll be like, oh, I need to organize that. Okay, so let's do some more rotation theory. We're gonna build this out a little bit more. Um, First, let's take his idea that he said, can we rotate into different tickers? Let's find some of the oldest technology uh, tickers. What's is there? Send it to me. Have you looked into Moneyball theory? Um, I mean, yeah, I've watched the movie. I know the story. What do you mean specifically about Moneyball theory? Is it true that lower standard deviation of return say, would indicate a trend? Yes, yeah, but also higher standard deviation could indicate a switch in trend. Um, Technically. Oh, I okay, yeah. Um, well, this is just technology. Um, okay. Yeah, so this is essentially but the downside of this is hindsight theory or hindsight biased. Um, Actually, no, most of these companies are pretty damn old. Yeah, most of these companies are very old. Let's cop. Yeah, that's true. Okay, we are going to make another version of this. I'm going to watch this one, and actually, I got to switch this to calendar because I know Derek's would be screaming at me. Um, they just need to set it to default. That's another that's another quality of life request that to Donovan has set the fucking thresholds to a default. Okay. Also, I got into the beta, but I don't think I can do. Can I do? the- Do I have the? Ah, I don't have it yet. It might be in my original thing. Let me message Donovan real quick. Okay. 10 days standard index XLK, old tech. All right, let's try this. We're going to copy this and we're going to attempt to make this better. I'm going to get rid of Hello Algo World. We'll get rid of XLP because I've already kind of demonstrated that. Uh, Hello World plus gold. So this is the new one. We're going to try to beat this. 2007. All right. Delete XLK, paste. Now we might have to change this sort function to something else. Yeah, it underperforms. Yeah, let's do sort function of relative strength index. We'll select the lowest of the low, bottom three, and add this to a group. A little bit better. This is an industry. Are you fuck off Excel? Are you doing a fundamental screening group breakdown? Food and beverage. Here, I'm going to invite you to kind of explain what this is. If you can hop on here for voice.
Hey guys, can you hear me?
Hey, what's up, man?
Hey, thanks for the invite. Yeah, so I was just uh, thinking. So the spreadsheet that I send is basically a weekly. It's groomed weekly by Investors Business Daily, and it reflects their 197 at last count industry groups or sub industry groups, if you will. Um, so my thought was use it as a point of reference to see, okay, which are the industry groups that are leading the market for a given time period. And then the second screen, if you will, one would have to do as far as incorporating that into Composer would be, well, look up the stocks or ETFs specifically in those leading industry groups to then incorporate them into a particular strategy, right? So it would be a two-pass effort, but the um, the genesis of my question, I guess, was just trying to understand. uh, So I know right now you can manipulate a strategy or create a strategy and select from the universe of funds, ETFs or stocks that are out there. But if you could use something like this as a data source to then focus on whatever pertains to each of these industry groups as far as leading stocks or funds, that would be interesting.
Yeah, I this is where we really need fundamental screening for Composer. It's one of the major requests that I've had. You can manually do it. If do you have a list of all of the tickers for these?
I do. Yeah, I can certainly provide that to you guys.
Yeah, send it to me. I'll build it right now.
Okay. It'll take me a little bit. Let me see. I don't know how quickly I can export it to a spreadsheet, but let me work on it and I'll get it to you one way or another. Cool. Thanks, guys.
Yep. Yeah, so I'll show you how you would do that while he's getting that ready. Um, all right. So this yeah. Okay, let me show the Jesse Greeter screener for anybody that doesn't know. Jesse Greeter is a fundamental analyst who's a friend of mine. He runs a private equity firm of about $30 million. And where's it at? This was a screening done on FinViz, and actually it was incorrect. There was some issues with it, but this was the screening that I did to scan for fundamental stocks on FinViz, which don't use FinViz anymore. TradingView is a much better screener. Um, but I was essentially looking for companies that were super defensive or had high cash flows and low debt to equities with decent returns to build a basket of tickers. So I was looking for price to free cash flow over 10, which I think that's incorrect. It should have been below. Sales growth positive, return on equity over 20, return on investment over 30. Quick ratio over zero point 0.5, which means they have at least 50% of cash on they have 50% of short-term uh, cash on hand to pay for short-term liabilities or like short-term debt, which is about short-term is within 1 year. So like basically like your vendors and your like cost of goods of business per year, like all the short-term debt. That's what quick ratio measures is how much cash do you have to pay off your expenses for the current cycle. Earnings per share growth, so growing earnings per share over 5, and then debt to equity under zero point 0.5, which debt to equity is long-term debt. So any debt that is 1 year or more, typically equipment, machinery, loans, any real estate, any kind of long-term debt, and then your equity, which is actually how much assets you own, under zero point 0.5. 0.5 means you have at least double. You technically have double the amount of equity to pay for your liabilities. So the lower the debt to equity, the less debt that the company has. So if you get into like a 25% debt to equity or a 10% debt to equity, essentially those companies have no debt, which is really great during recessions. Um, okay. And then I just threw all these in and I did a sort index of relative strength index of bottom 7. So I'm selecting all of these assets to the bottom 7. And it's actually underperformed um, from the SPY year to date. Did well during bull market a little bit. Did really well during the back test. But yeah, that's an example. Whoever was asking that question, Doji, is basically you build a basket of these different sorts. Now, I can tell you that one of the best sorts, because I did a test. Um, let me double check. I've got a presentation. I've got another call. I can do another 10 minutes. One of the best metrics to sort algo or at least sort individual tickers by is bottom 35 RSI. You're essentially dip buying the lowest ticker over that period. I did a bunch of tests. I actually went through and tested every single strategy or every single indicator for what is the best metric to sort individual companies by. V1 daily RSI. So you can see here's all of the bottom RSIs that I tested. I essentially went through and I tested 10-day, 2-day, 120. I tested 5-day, 10-day, 20-day, 35-day, 60-day, 126-day, 256-day, and I even did 500 and 1,000 days for the other indicators. And I tested every single strategy, and I found that, or sorry, every single indicator, and I found that the best ones are the bottom 35 day standard deviation or RSI. V1 daily RSI bottom. If I add these all on here, you can see replicating the strategy, and all of these can be back tested to 1994. I basically went back to the 1980s and I built my own baskets of synthetic ETFs for all the different industries. So here's a bunch of companies from all different industries that started in or that were profitable in the 1980s, and then I combined them all to figure out like what is the best way to sort individual algos. And of course, it's not going to show the spider web. Come on. Oh, I know why. It's because of the 2 day. Turn off the 2 day. Or not. Maybe I have to turn off the 5 day as well. For some reason, the 2 and 5 day RSI. There we go. And then we have bottom 35 RSI. Seems to be the best out of all of them. I'll give you guys the strategy if you want to mess with it. Yeah, go ahead, Idealator. Database can be found here.
I too enjoy stuff.
So there's a book called Market Sense and Nonsense that comes to my mind. This book is a statistical algorithmic back testing book it basically goes back to the 1970s, and it tests the questions like, is it better to buy the top stocks over a 1, 3, and 5 year look back, or the bottom stocks over a 1, 3, and 5 year look back? Is it better to invest in a hedge fund or a mutual fund? And then is it better 1, 3 year, and 5 year? And it basically goes back and tests a whole bunch of theories on like what is the best way to invest in companies. Um, it's actually, at least in that book, it was said that it's actually worse to invest in the best companies because all of the profit arbitrage has already occurred. And that makes sense when we go back to the sector rotation theory, where um, if you have $1 billion and you invested in the S&P 500 through the 1980s and 90s, and you start taking your profits out, are you going to continue to invest in the top performing companies, or are you going to be looking for a different place to put your money and invest in different things? So it might not necessarily be the best to invest in the best current leaders. In fact, it's counterintuitive, but it might actually be better to invest in the worst performing, depending on the time frame. Which one would you which one would you like me to go through? Psychological indicators, stock out. Yeah. Psychological indicator. What is psychological indicators? Volatility, ratio, price premium, mutual fund share. Let's do ETF losers. Vietnam, silver, gold. Interesting. Do you have anyone you want to recommend that I go through? Let's do this. Let me see if I can find the noble strategy. Thought I built the noble. Yeah, I thought. Yeah, type of asset. I thought I built strategy for Noble. Yeah, I thought I would have called it Noble. Well, let's just create one, I guess. It'll be faster. So here's what we're going to do. For those that don't know, Noble is Dividends Aristocrats. Dividends Aristocrats is essentially the best dividend companies in the world. They also have usually the lowest dividend returns, but we're going to build a strategy that basically profits off of a select group of tickers. Now, the reason I like Dividends Aristocrats is because the requirements to get into Dividends Aristocrats is you have to increase your dividends payouts for 25 years straight. You have to have $3 billion or more assets under or market cap, and you there's a few other requirements, but like long story short, you have to be an insanely defensive, stable company to be in the dividends aristocrats list. Which means all of these companies are extremely defensive, extremely old, and probably very good for market crash or market recessions. And because it's got a 25-year look back, I know all of these companies have met these metrics for at least 25 years. So we're going to do bottom RSI, 35 days, and now going to do the very tedious work of adding every single one of these tickers in. Vox, mm, could do that. Let's see if that works. Let's go. Thank you for that fucking recommendation. Okay, now what do I do? Just copy it, or all right? I got tickers, AMCR, KView, KView. Old is noble. Uh, Michael B at 2 o'clock. Yep. 2013. We'll just do 2014. MDT. Okay. Then we'll add Noble. You probably won't get crazy arbitrage from this though, because of these companies are so defensive. But it definitely does perform better than Noble straight up. So this is an example of like how you would do this. You're essentially dip buying the basket of companies to arbitrage the difference, or like what you're selecting whatever is the lowest. And actually, this isn't even a sort function. This is just an equal weightings. That is not what I wanted. I wanted you to do a sort function. Can I change this? Yeah, it's such a oh, that's nice. Yeah, there we go. Now we're buying the bottom 35, which is even better. It's way better. Um, so over a long period of time, that definitely performs much better. So let's do this now. Let's do a dynamic switchboard. Um, for those that don't know, a switchboard algo is well. I'll just build it and I'll show you what this is. Um, we are going to do a rotation of baskets. Um, and this should actually, before we do that, let me undo all this. And we're just going to save, oop, nope, too far. We're going to save this as Noble RSI bottom 35. And also, we're doing a threshold, not a daily. So let's see what that does. Currently, it's 28,000. Actually, run it back. $28,000, 35% drawdown. We're going to switch this to daily. Basically the same thing. Okay, save this, then make a copy of it. Switchboard, and we're going to add that symphony to the back test. Now we're going to build a switchboard. Sort function. Okay. And we're going to do bottom RSI 35. We're going to do moving average returns at 35, bottom. Oh, wait, this is buying bottom 35. So it's still just buying. Hold on. Uh, let's go back to the other algo because it's basically buying every single ticker, which isn't a dynamic sorting. by the bottom 7. Better. Although we have a huge dip here. Let's do bottom 3. The downside of buying bottom RSI is you're also capturing the downward movement. So you can see that this kind of underperforms there. The more aggressive, the less tickers you buy, the more focused your sort function is. So you're going to be if a RS if RSI is really tanking and you're dropping really hard, you're basically capturing that downward movement. So bottom RSI is great during bull runs. It's not great during bear markets. Let's do top RSI. True, true. Just to diversify. You can also do standard deviation. Let's see. True. It depends on what you're designing for. But isn't it the point? Yeah. Just to show how to sort algos differently. We'll just do bottom 15 for now. Um, and then I'm going to switch this one to 15, bottom 15. But now with the dynamic switchboard algo, it's a bit different. So we're going to do moving average returns, 25 days. Let's select top 15. Then we're going to do standard deviation of, uh, actually, I think standard deviation of price. Let me check my records real quick. Where where the hell's my group? There we go. Looking for standard deviation of price. Because I think standard deviation of price on tickers is actually really good. Shit. Okay. Top price, bottom price. Standard deviation of price does really well through the bear market of housing market. Didn't do so well through the housing market crash. Thought I had metrics on. We'll stick to what I know. Um, Standard deviation of returns, 35 days. I'm going to select the bottom 15. And then I'm going to switch this one to top 15. And then I'm going to do max drawdown, 5 days, top 2. So now, let's see what this does. Does worse. Interesting. Hmm. If we're going defensive, bottom standard deviation would be the best. Really isn't that wouldn't Noble huh. I mean, it's got a bit lower max drawdown, but not as much as you'd think. As for those that don't, for those that might not be following though, a switchboard algo, essentially what I'm doing is I'm measuring bottom RSI. Oh, wait a second. Let me change this. This might be why. That's better. That's much better. But it's still got a 35% drawdown. Interesting. So what I'm doing is I'm sorting. I've got four sort functions here that are inside another sort function. So I'm measuring bottom RSI, dip buying bottom RSI, dip buying bottom moving average returns. Then I'm doing highest standard deviation, which is the most aggressive, the highest full throttle strategies or tickers, and then the lowest full throttle strategies. Then I'm sorting all of these based on whatever metric I want here. So if I do max drawdown of like 7 days, I'm essentially selecting the two that have the lowest drawdown or the two that are moving up the most. Um, which this should, I'm basically setting a limit on my volatility, which is why I'm getting a lower volatility. But this is actually underperforming the Noble. But this is how you basically build a switchboard algo. Um, The now the way to do this is technically to use actual algos, like actual algos with actual logic. This is just a sort function. This is not an actual algo with a sort function. So you'd actually nest a bunch of different algos in here. For example, let me show you one. Well, you have to experiment with it, but I mean, I don't like the performance of this. It's not the loss in AR is not worth the drawdown difference. Um, but I'll show you an algo that does perform well through this. Let's do Dynamo. So I would, yeah. So my take would be, you would want to build this for specifically defensiveness in a bear market, which means bottom RSI wouldn't be the best thing to do. Um, yeah, but this is a algo switchboard. So these are all individual algos that have their own logic bases in them, and I'm building the switchboard with a 15-day drawdown, and then you can see that it's just basically a straight equity curve up. 8% drawdown, 50% annualized return, and it's extremely diversified. You got all kinds of tickers that are less than like 2% on each one. So that's an algo switchboard. But I got to hop off here. I hope you guys enjoyed this call, and I got to jump on this next meeting that I got. If you have any questions, shoot them in the newbie chat. But other than that, I hope you guys enjoyed it.